In this lecture we are going to analyze a trade that happened in the British pound versus the US dollar in the 15-minute timeframe. This is a good example of one of those scary and counterintuitive trades to take because of the violence of the movements involved. Oftentimes in trading you will find yourself under the necessity of gauging your rationality and your natural impulses. This can be difficult in a situation like the one we are about to see in this example. There is nothing special about the way this manipulation occurred in this chart. As usual, we can observe price creating its natural flow downwards from number 1 to number 4. As you can notice, the market vectors are quite large, and it's easy to see that we are dealing with the major flow. From number 4 to number 5 is where things start to shift a little bit, but in a very subtle way despite the size of the movements. This is somewhat of a paradoxical message. At the same time that price is subtly changing its dynamics, it is producing wild and volatile movements. Most traders only notice the second part of this message, of course, because they have not trained themselves to perceive the subtleties of price action. I say that price started to change its behavior from 4 to 5 because price was able to climb up exactly to high number 3. This is a sign of strength of buyers in a downward market. It does not mean that buyers are dominant yet, but it does mean that they are stronger than they were previously. If that was not the case, the buyers would simply fail to create an extreme as high as number 5. That's the first clue that you should pick up in this chart. The second clue, which should be obvious to you at this point, is the combination of a price signature and the von Riestorff effect in its obvious form in the market vector from 5 to 6. Observe how price falls hard after 5 and also how every candle creates a lower high, meaning that large traders were probably trying to pound the high of every candle to produce the von Riestorff effect. Meanwhile, the retail traders are looking at the vector between 5 and 6 and they are certain that low number 4 is an awesome place to trigger a sell trade. After all, just look at how violent the sellers are in the way down from 5. This is an illusion, of course. In candle number 6, price pokes the low number 4, triggering the cluster of orders that was lying around. This is of course performed by large traders who deliberately push retail traders off the cliff here. By triggering the cluster of orders, a deep liquidity pool is created, and the market depth increases significantly. This is where large traders can open their large positions, which in this case would be a long position. All of those suspiciously large lower tails after candle 6 are nothing more than large traders entering and re-entering long positions to tilt the market to the upside now. At this point the retail traders are really upset because their trade idea is not working at all. This is where ape-like behavior starts to kick in and survival mode lights up in the brain of retail traders, so they naturally try to reverse the position to the upside out of pure desperation. This is how the reverse psychology part of the manipulation is successfully employed, and it's immediately followed by the bandwagon effect. Candle number 6 poses a few different opportunities for people like us who understand the underlying mechanics of market makers. Observe that I drew a few lines in there. Let's discuss them a little bit to see what could have been done and why. The first and most obvious line is the blue wash line that has its origin in the low number 4. As you can see, after number 6 price action came back to this line one more time. This could have been used as a trigger point, and it would be a precise one. The other line we have is the red frequency line that catches the frequency of the lower tails of lows 4 and 6. Price tests this line 4 times around low number 6 using the frequency discovered in the lower tails of low number 4. You have 3 different chances to trigger a long trade after the candle 6 if you were to use the red frequency line. The third line, and perhaps the most difficult to draw, is the green sloped wash line. To be able to draw this line with this angle, we need at least the candle after candle 6 to catch the sloped frequency. After that, price touched the green line one more time up to this point. The trade you see opened in the chart was triggered when price touched the green sloped wash line for the first time, as it is indicated in the green arrow. The stop loss is naturally placed below low number 6, and the target is placed at high number 5. Let's see how the market develops. As you can see here, the manipulative process was successfully identified and it produced a very nice long trade opportunity.